everyone. I am Noelle with Verivest, and today with me, I have Ray Walter and John Konakci from Capstone Fund. How are you guys doing today?
I'm wonderful. Great. Thank you. Good to see you.
Good to see you guys too. Let's get right into it. What is the story of the Capstone Fund?
Yeah, so I grew up in Orange County, California, and I learned everything about real estate from my father. And in the early 90s, he started looking at real estate outside of Orange County. And he came to Austin, Texas. And on one trip, he actually purchased 3 investment properties by the time he flew back to Orange County. And I got to witness that and just really see my dad. He was a great real estate investor, conservative. He never liked to sell anything. He always liked to buy and hold. And that was the family I grew up in. And that investment strategy is what brought me out to Austin. And so I moved out here in 1998 and worked for a company called Countrywide Home Loans, which is where I learned everything about lending in real estate and lending against real estate. And in probably around 2005 is when I noticed the private lending market. I was really intrigued by the creative financing, individuals that were needing creative financing, private funding for real estate. And it just wasn't available on which would be the conforming market. And being an investor myself, I studied everything I could about that industry. And I started with my own capital. Just had a little bit of capital saved up at that time, and I did my first private loan, and it grew organically from that first loan, and worked a lot with real estate agents, loan officers, and I just started, telling individuals that, hey, we've got some private capital, we'd like to lend it out. We don't have a lot of capital, but we've got a little bit, and we started small, and it grew organically from there. And in 2012 is actually when we officially launched Capstone Capital Partners. And that's when we started with fractionalized lending for trusted investors. And that's how Capstone started. And soon after that is when we started the mortgage fund.
If I add something to that?
Absolutely.
Well, I just simply wanted to kind of basically help you wrap that up by saying that Capstone Capital Partners was founded in 2012, as Ray mentioned, and has funded more than $100 million in loans in real estate, in the real estate market. The fund basically deploys money for loans for real estate projects and projects in Texas. Capstone has more than $30 million of investor funds under management with more than 120 investors. We work with individual investors and registered investment advisors who are seeking in investments outside of the stock market with good returns, monthly income, and low volatility. Their priorities are protecting their principal investment and steady growth.
Awesome. What drove you guys to start the Capstone Fund?
So my primary passion for launching the Capstone Fund was allowing better diversification for our investors. We also noticed that there's downtime in between investments on our private loans. And so we would have one investment pay off and maybe another 2 or 3 months before an investor can redeploy that capital. And so that was one of my primary focuses when I launched the Capstone Fund, was to minimize downtime between investments and to also keep that capital working. And also we work a lot with passive investors, and a lot of times they don't have the ability or the time to look at every transaction that we send them. We have a very comprehensive underwriting package that we put together when we did our fractionalized lending program or trusted lending program. And particularly the investors that have, some of them have been investing for decades on trusted investments. And once they understood our underwriting style, they just didn't really have the bandwidth to look at every transaction that we sent them. And so when we launched the fund, it gave them the ability to have better diversification and to have their capital working on a 365-day cycle.
Awesome. How do you source your deal flow?
So we have a full-time loan origination team. And believe it or not, actually one of our originators used to be our borrower. And he borrowed probably several million from us over a period of about 8 years. And when he took a break from real estate acquisitions, we decided to hire him. primarily because of his experience, his real estate knowledge. And so he's very well networked, including our processor who came from a bank. And so our origination team is they're networked within the real estate community. They're networked with builders, with individuals that do fix and flip transactions, commercial developers. And they're just a great team that works together, networking in the community. But primarily, most of our business is by repeat and referral. We build relationships, one transaction at a time. That's really important to us. Trust is the number one way we build our business. And we get to really know our borrowers, especially some of them we've been working with for years. And a lot of times we're coaching them, we're counseling them on transactions that maybe to walk away from. And they respect that with us. And we've been in the business long enough to notice a good transaction from a bad one. And so they also depend on that experience. So we're really partnering with our borrowers, and they really appreciate that about us.
Great. Tell me what key markets you guys operate in and why.
Want to answer that, John?
Oh, sure. Absolutely. That's a fairly easy question to answer. The Capstone Fund primarily deploys loans in Texas only, and there are really three key reasons for this. The first one is Texas has laws that are very lender-friendly. It's a non-judicial state. We can talk about this in more detail, but in a nutshell, Texas being a non-judicial state, if we had a situation where a borrower was unable to make payments or the loan fell into default, we would be able to foreclose on the property in as little as 63 days. So that gives us a way to protect our investors' capital by being able to foreclose on a property, take it back, sell it, get the investors' money back, and then redeploy it into a new loan. The second reason that we do loans only in Texas is that Texas is also has a very business-friendly climate. It's low regulation. The second reason that we only do loans in Texas is because Texas has a very business-friendly climate. As a result of this, more and more businesses are moving to Texas, and especially to Austin, particularly because of Austin's unique culture and its highly diverse and highly educated workforce. And finally, the third reason that we do loans in Texas only, and primarily in major metropolitan areas, is because we want to have feet on the ground and eyes on the projects that we fund. We want to be able to monitor the progress and be able to work very closely with all of our borrowers. So those are the three key reasons that we do lending in Texas only, and because of the economic growth in Texas. It's really an economic engine of the country. Because of the growth in Texas, we have basically plenty of loans to work with.
Yeah, I do.
What is your investment philosophy, and how do you determine whether a deal is worth doing or not?
So that's a great question. One of the primary ways that we mitigate risk is we only lend up to 70% of the market value of the property, and that's in most cases. There's a few exceptions to that rule. So in almost every scenario, we have at least 30% equity in that transaction. Not only does that minimize loan defaults and foreclosures, but it also ensures that the project is going to succeed and that we're not going to experience any type of default on our side or even a slow payment on our side because the equity is so strong. As an asset-based lender, that's rule number one, is we don't overlend on a property. In addition to that, we have a loan committee of 5 experienced professionals and various backgrounds, anywhere from construction to fund management, and every transaction. John's been in those meetings along with myself and the rest of our team, and we scrutinize every investment that comes, or I should say every transaction that comes through our table, and we have turned away as many as 50% of the loan applications that come to us on a regular basis. And we want to stay conservative, and we don't want to risk funding a bad transaction. We've done that before in the past, and those are hard to get out of, and so we learned our lessons. Mm-hmm. And we always want to stay conservative. Did you have anything to add to that, John?
The only thing I would add, I think you've actually said it mostly, is 5 people are looking at every loan, scrutinizing it and just asking questions to the origination team. Right. Again, we scrutinize these loans now before we even actually decide to fund them, so that we don't have to deal with issues later. And when you have such a diverse background of investment professionals, really,
That's right.
including our origination team, and one of the members, the leader, is a former builder himself.
That's right.
So he has a lot of experience with construction. Ray's experience with real estate, my experience and background in fund management, as well as a couple other individuals. I should add that one of the members of the origination team has a background in banking.
Yeah.
So all of those really contribute to really scrutinizing each loan deal thoroughly.
So you guys kind of just touched on it, but what are the measures that you guys have in place to mitigate the risk to your investors?
Would you like to touch on that?
Yeah, I mean, our business is about actually mitigating and minimizing risk to our investors. We could speak a whole hour about this topic. There are a large number of measures that we take to minimize risks to our investors. I could start at a high level and just say that the fund structure allows investors to essentially diversify their investment across a portfolio of 60 plus loans, and which is basically growing every month. This way, if one or two loans actually did not perform, their impact on fund returns would be minimized. Our PPM allows us to invest in real estate projects across the nation, but we are choosing to invest only in major metropolitan areas in Texas for reasons that we already discussed. Just another way is we focus, as Ray mentioned, we focus on funding loans with a loan to value of 70% or less, with few exceptions. And again, as Ray mentioned, this means that there's usually at least a 30% amount of equity in each project to buffer investors from default and or drop in real estate valuations. There are several more that I could go through, and I'll just quickly kind of summarize in my mind. One is all loans that we do are first lien position only. So, and that means that no other lender comes before us. We focus on keeping our loan sizes small and actually manageable. Our average loan size is around $900,000. This way, if again, one or two loans don't perform, their impact on fund returns is minimized. Even more importantly, we manage our, what I would say, borrower concentration of loans to ensure that not too many loans and loan dollars are concentrated on just a few borrowers. That's very, very important because many other funds have actually suffered for this. If too many loan dollars or loans and loan dollars are with few borrowers, if that borrower happened to have any issues, have any defaults or foreclosures, it usually has a cascading effect on all the other loans, and the fund can suffer greatly. Our loan terms are generally short. I would say 12 to 24 months. This means that our capital is not tied to any one particular project for a very long time, and it means that we can actually respond to market conditions quickly and price our loans accordingly. I would say that we're very selective about which markets that we invest in. We're very blessed to be doing business in the Austin, San Antonio markets, which have been highly active with very high demand for real estate. One example I'll give is that Houston is the largest real estate market in Texas, but it holds the smallest portion of our loan portfolio. And this is because the Houston market is actually the I would say, most volatile market in Texas. Therefore, we are extremely selective about which real estate loans we do in Houston. Another way we mitigate risks is by focusing on single-family residential loans, which have very high demand. And we actually minimize investments we do in land loans, which in the event of a default can be much harder to sell. That's another way we're actually mitigating risk for our investors. All loan servicing is conducted in-house, which means we can manage and actually control the quality of it and make sure that interest collections are done efficiently and accurately. All real estate appraisals are conducted by independent third-party appraisers. For an extra layer of scrutiny, all fund accounting of the Capstone Fund is conducted by a third-party firm. That means that there are other eyes looking at our fund and our accounting transactions on a regular basis. And the Capstone Fund is audited on an annual basis by an independent national accounting firm. I would say, finally, the last one, I've gone a little too long here, one matter which is critically important to investors, especially investment advisors, is leverage. The Capstone Fund uses no leverage to inflate earnings. We have a small line of credit basically for, I would say, temporary liquidity to fund loans between payoffs and the arrival of new capital into capital investments. By having no leverage in the fund, it means that we manage the fund, and the fund itself and the investors are not at risk of the bank taking over the fund at any time. So it's a very important topic. It's the most important topic for our investors. So I'm glad you asked that question. But yeah, so we do take a lot of measures to be able to mitigate risks for our investors.
I thought I would add, if I could, on our average loan size, which is 900,000, it's actually many times we fund multiple projects, not necessarily a multifamily. But for example, we'll if it's a new construction project in Austin, a lot of times what builders do is they'll build anywhere from 2 to 4 single-family units on one property. And so some of these loan amounts, so if you have an average loan amount of 900,000, it may be divisible by 2 or 4. So in other words, per unit or per single-family home, it could be as small as 200,000 to 300,000, depending on the transaction per home. And so I just thought I would insert that.
Explain how that's advantageous for investors.
It's advantageous primarily because number one, if you have 2 or 4 units, you've got 2 or 4 different exit strategies, and so your basis per property is actually lower. And so when you hear maybe 900,000, you might be thinking more of a luxury type home. It's actually quite a bit less than that. Our average transaction, or I should say our average loan amount per property, is probably a little bit closer to, on an average, probably closer to 300, maybe 350,000. So I just wanted to add that.
Yeah, I'm glad you said that.
Yes.
Awesome. Thank you so much for that last answer. That was great. It was so nice getting to know you guys. Thanks, Ray and John, for joining me today.